Look, if you're a super saver or a super investor, then you should already know that maxing out your 401k and maxing out your IRA is one of the best things that you can do to avoid paying taxes and grow your net worth. But one thing you might be wondering, if you have already maxed out your contributions to those two accounts, is what else should you invest in next? What's the next best option for you to keep investing and keep growing your net worth at a rapid rate? Well, today in this video, that's what we're going to talk about. So if you're at that point where you're maxing out your 401k and you're maxing out your IRA, we're going to discuss 5 other places where you should be investing your money. And the very first one that I want to talk about is the health savings account. I'm a pretty big proponent of the health savings account because it's really just an IRA in disguise. It's really like a traditional IRA in disguise. These accounts are there to be intended to be used for current medical expenses or future medical expenses. And in order to open up one, you need to have a high deductible health plan. And the minimum requirement that the IRS sets for having a high deductible health plan, your deductible in 2020 needs to be at least $1,400 if it's for a single person, or it needs to be at least double that of $2,800 for a family that is covered under the HSA. The great thing about the HSAs are that there are no income limits, so there are no phase outs. It doesn't matter how much money you make, you can contribute to an HSA as long as you have a qualified health insurance plan with a high deductible. Now, the maximum amount that you can contribute to these accounts, at least in 2020, is $3,550 for an individual or $7,100 for an HSA that covers an entire family. Here's how they really work, on a very basic level. You make your contributions to your HSA and you can invest within it. So the contributions that you make are tax deductible, which means they reduce the amount of taxable income that you have, just like a traditional IRA. While your money is in there and invested, it grows tax-free, so you don't pay any taxes on any gains that you make within the account. Now, you can withdraw any amount of funds that you need for qualified medical expenses, and the IRS has a list of qualified medical expenses on their website, but also usually the HSA account that you have, they usually come with another list too. So if you have those qualified medical expenses, you can withdraw money from your HSA at any time, at any age, as long as you have those expenses. And you won't have to pay any penalty or any tax on that amount when it's used for those qualified expenses. If you withdrew money and it wasn't for qualified medical expenses, then you would have to pay taxes on that amount of money as income, and you would have to pay a 20% penalty, which is very, very steep. So they don't want you withdrawing money from it unless it's for medical expenses. That changes once you reach age 65. So when you reach age 65, you can withdraw money from your HSA, even if it's not for medical expenses, like qualified medical expenses. You won't have to pay that 20% penalty. You would still pay tax on that withdrawal as ordinary income if it wasn't used for a medical expense, but you no longer are subject to that 20% tax after age 65. You can see how it can be a really good regular retirement investment vehicle, especially if you're not planning to retire until you're 65. An HSA is a really awesome opportunity if you have the ability to use one. All right, idea number 2. If you've maxed out your 401k and you've maxed out your own IRA, another thing that you could do if you are married, you can contribute to your spouse's IRA. Even if your spouse made $0 in earned income, you can contribute on behalf of them. So as you might already know, in 2020, the maximum amount that you can contribute to an IRA is $6,000, and that is per person. So if you're married and let's say you're a single income family, you can contribute not only to your 401k, but you can contribute to your own IRA and to the IRA of your spouse. So that is a total of $12,000 that you can put into 2 separate IRAs, $6,000 and $6,000. And like I mentioned, that is regardless of whether the spouse that you're contributing to has any earned income or not. All right, idea number 3 is simply just a taxable account. So any kind of regular taxable investment account. You can utilize taxable investment accounts, and I think that they have some pretty cool benefits. Of course, the income that you make, there is not going to be any kind of tax benefit from them. So the money that you put into your taxable account, you're not going to reduce your taxable income, and any kind of earnings that you grow while it's growing, you're going to be taxed on that. So let's say you make an investment in a taxable account and that investment pays dividends. Well, you're going to pay income tax on the amount of those dividends. Same thing, if let's say you invest in a mutual fund and then the mutual fund manager makes short-term capital gains. well, you're going to pay taxes on those capital gains at the end of the year when you go to file your taxes. While that might kind of sound scary, generating more taxes, there are many investment vehicles that you could use that are very, very tax friendly and are especially very useful to be used in taxable accounts. One good example that I like to use is ETFs, which are exchange traded funds. So a very simplified explanation of ETFs they are mutual funds that trade like stocks. So really it's a collection of different assets that you can buy, but their price fluctuates just like a stock and they're traded on the stock market pretty much the same way. So they're like a hybrid between mutual funds and stocks. Exchange traded funds are known as being very tax friendly. So when you hold them in a taxable account, you would probably pay very minimal amount of taxes on them unless you sell them and actually realize a capital gain. And there are many other different investments that you can make that are pretty good at minimizing the amount of taxes you make, even though they're in a taxable account. The great thing about taxable accounts is that you already paid your taxes on that income. You can withdraw at any time for any reason. There's no penalties, no waiting, anything like that. And you only pay additional taxes on your gains, obviously not on your principal because that amount was already taxed. So don't forget about taxable accounts when you're making your decision. The next one I want to talk about, number 4, is if you are self-employed or if you are doing like a side job where you're considered self-employed, then you should consider opening up a SEP IRA. So SEP stands for Simplified Employee Pension. And really what it is it is like an IRA that is exclusively contributed to on behalf of the employer. So if you're just self-employed, you can contribute to that IRA kind of like a traditional IRA. And it is totally separate from your regular IRA. So yes, you can contribute to a traditional IRA and you can contribute to a SEP IRA at the same time. The traditional IRA or the Roth IRA, whatever it is, the regular IRA is considered an individual contribution, whereas the SEP IRA is considered an employer contribution. And the employer in this case being yourself because you are self-employed. So there are definitely some different rules when it comes to the SEP IRA, but really you can kind of think of it just like a traditional IRA. So the amount that you contribute to it reduces your taxable income. It grows tax-free in there, but when you do withdraw from it, you pay income taxes on that amount. Very similar to a traditional IRA, and it does come with its own separate limits. So in this case, in 2020, if you are self-employed and you're the only worker in your little self-employed business, you can contribute up to 20% of your earnings from that self-employment income or up to $57,000, whichever is less. So consider a SEP IRA if you do have a side business or you're self-employed in addition to your regular job. And number 5 is, why not invest in a business? You can invest in starting your own business. You can invest in buying an existing business, or possibly you can invest in someone else's business. However you choose to do it, there are definitely benefits for owning a business or operating a business or being invested in a business because businesses have unique circumstances. Not only do you have the tax benefits of business expenses are tax deductible, also when it comes to owning a business, you have the potential to make more income. And by getting involved into investing into a business, you could open up doors for that SEP IRA or a solo 401k or any kind of other retirement or investment vehicle that is unique to businesses. Even just a small side hustle that you might not be really concerned about, just making a little bit of extra income, can be considered a business. Even if you're just doing ride sharing for like Uber or Lyft, or you're on Airbnb, you can kind of turn that into a business and make it extra profitable for yourself because businesses come with some very unique circumstances over plain old W-2 employment. So there you have it. If you max out your 401k and your IRA, these are 5 new ideas for you. I hope that at least one of them can be beneficial to you, and I hope that it helped you out. If you like this video, I would really appreciate it if you liked it on YouTube for me. And subscribe to the channel because I'm putting out information on personal finance all the time. And I think that some of that information can benefit you. Thank you so much for watching. I'm Zach from OnCashflow.com, and I hope to see you next time.